But what I thought I'd do on the next slide is just start with what are the new limits? David actually went through most of these limits in his discussions, but I thought I would mention a couple that he didn't mention, one being the maximum taxable wage base. That's right about in the middle. So that's increasing from 142,800 to 147,000 this coming year. So that's just where you pay your Social Security taxes on, or at least the retirement portion of the Social Security tax. The other items that you heard about throughout Dave's presentation is the annual compensation cap right above that. So we can count more pay now in 2022, if a person happens to earn that much, in calculating benefits and doing all this complex testing that David just went through. The other item of interest when thinking of cash balance plan is right below the taxable wage base, the defined benefit annual limit. So the annual pension limit, as Dave mentioned, is increasing to 245,000. That all we're really saying here is we have more room to put money into a cash balance pension plan, if that makes sense for you. Next thing I wanted to talk about on the next slide is really the relationship, the client focus. So we heard about rules and all of those we take care of for you. So it's nice to hear about them and understand generally what's happening. But what's really important for our clients is the coordination of effort, I think, between the actuary slash consultant, your tax advisor, and your investment advisor. All three of us are working together to satisfy the client's needs. And it's real important up front to work together. And it's real important at the end to work together. And in the middle, there's a little bit of ongoing communication back and forth. But when you think about those rules that David just went through, that's the kind of stuff we do. And then we present it to the client, usually with the investment advisor and tax advisor, so that they know what kind of contribution arrangements can we make for this plan or these plans. Typically, there's two of them, a 401k and a cash balance pension. And that's where the client hears and the input of all the different parties and comes up with the right plan for themselves. Next, I guess you have to ask a basic question: is a cash balance plan right for us, for you? Well, it depends. You have to be financially successful. The whole reason we're looking to a cash balance plan is that you want more than a 401k plan. So piece number one of the puzzle is you have to be financially successful. Piece number two is your income has to be predictable. In other words, if you had a banner year one year, you may not want to commit to a cash balance plan because it's going to have required contributions into the future. If your income is high and is predictably, it should remain high, this might be just the plan for you. Of course, you're in a high tax bracket. That's one of the reasons to take advantage of a qualified plan anyway. So you have a tax deduction or deferral of taxes technically by putting the money in today, and then you're taxed later when it comes out, many years from now, either through a lump sum to your IRA or distributions out of the plan. The last piece of knowing whether a cash balance plan is right for you is if you have employees and there's favorable demographics, which really means the people you want to favor are older. So typically we have an older owner and a younger staff, and that's when you go back to David's calculations and crank everything through. What you conclude is you can favor the owner by an extreme margin oftentimes compared to the staff, primarily because they're older. And just the general concept, without going into all the calculations, the general concept is it takes a lot more money for an older person, for a deposit for an older person, to have the same pension benefit than it does for a younger person who has many years to accumulate and let that grow for their retirement. That's the whole concept between cash balance plans or traditional pension plans for that matter, to favor the older employees. Let me give you an example while we're here is an age 60-year-old, for instance. I'm age 60. I'm very successful. and I'd like to save additional money for retirement, push down my current taxes and defer it to a later point when hopefully I'm in a lower tax bracket. I could we could design a plan for you that would put in as much as $264,000 in your name in retirement for your future. Then, however, if you back it off to age 50, that limitation drops down to 158,000, and at age 40, 95,000. So still can work at age 40, but as you see, as you get older and older and closer to retirement, that's when you can have significant contributions to a cash balance slash 401k plan. So how do you design the plan? On the next slide, I really talk about the plan design and implementation. First of all, it's easy. You share what you want to do. What am I trying to accomplish? Sometimes we get requests, I want to maximize the owner and minimize everybody else. And that's what we go for. So we establish that. Other times it might be a slightly different objective. I want to favor this person or that person. But either way, we can design a plan that gives different amounts for different categories of employees. For instance, you might have owners receive 100% of pay as a cash balance credit. You might have their spouse at 50% of pay, and you might have staff at 3% of pay. Now, all this has to work out testing wise with age and so forth, but step one, share what you want to accomplish. Then our team goes back and we work toward that objective. We do everything we can to design a plan that would satisfy that overall objective. And we do lots of illustrations. They come in daily, at least more than daily. And we probably do a couple hundred a year, just looking at it and seeing, does this make sense for the client or not? Sometimes it does, sometimes it doesn't. But that's step one. We use those techniques Dave described under the cross testing to see if we can get to those objectives. Then we come back to you. If we can pass all the testing and satisfy your objectives, then you look at it and you decide if the plan's appropriate. If you like the plan, we write a plan document and we use pre-approved prototype documents. Basically, these are much like a 401k if you have a 401k plan already. Where you pick and choose the eligibility, who receives a benefit, how much that benefit is, when it's paid out. All of those features of a pension plan are picked and chosen on these pre-approved prototypes. And we like them because they're cost efficient and also they're as flexible as possible, and you're within the IRS regulations. Now you have a plan, it's up and running, and we have to administer it and test it annually. So let's talk about that. What happens each year? On the next slide, we just have kind of an illustration of the different items that happen throughout the year. Oh, I'm sorry, I skipped a slide here. I guess most plans are 401k and cash balance combo plans. So if you thought about what David was presenting, what you concluded is it takes two plans to best design a program. One is salary deferrals in the 401k so that you can save, and it's flexible, as much as you want up to the upcoming year's $20,500 limit. So that's piece one. That's flexible. Every one of your people decides how much they want to save out of their pay for retirement. Feature one. Feature two is typically the 3% of pay safe harbor. Now, Dave talked to you about two safe harbors. One of them was 3% of pay. The other one was a matching program. And I know myself personally in the past, I always liked the matching program because you wanted people to participate in this savings for retirement, and a match does a good job at enticing them to save. However, for cash balance 401k combo plans, it's almost always better to use the 3% of pay safe harbor. You're going to give everybody 3% of pay, whether they're saving any salary deferrals or not. Now, why is that important? It's important because we can use that 3% of pay in completing that testing that we were looking at earlier. So it gives us a leg up on satisfying non-discrimination testing, which makes it a little bit easier for us to design the plan just the way you want. Then I'm still in the 401k plan under the discretionary profit sharing. And this is where we design our profit sharing plans where it's discretionary. Employer decides how much, and the employer can even pick individually among individuals within the plan to receive greater or lesser amounts at their discretion. Now, we do have to test all those things, but the reason we make it that way or design the plan that way is because sometimes we need an extra deposit for a younger person in the profit sharing plan to satisfy testing. So that gives us and you the flexibility to pass testing without significant contributions. That's kind of our safety net there. Then lastly, a separate and distinct cash balance plan supplement. And that this is your traditional pension that looks just like a defined contribution plan, but operates different, has different limits. And that's where we can design the additional deposits for you to round out the whole picture. So that's a typical arrangement that we might end up with for our clients. So what do you have to do each year? On the next slide, there's a few things. One, you have to provide us the census data. The census data is given to us with date of birth, date of hire, date of termination, salaries, etc. I'm going to go through each one of these in a little more detail because I have a slide for each. Then we need to know the trust fund activity, your investment account. Then our team, the actuarial team, prepares the annual valuation. So we gather this information and come up with a report for you. It gives you certain information. Then you decide how much you want to fund into the plan. Remembering it's a defined benefit plan, remembering you have a target to attain to later, but you are going to have some flexibility in between. And lastly, the responsibility of an employer is to submit the annual reporting and also provide participant notifications. Let's talk a little bit more about the census data on the next slide. Not too difficult. Just provide us the information, the people's name, gender, date of birth, date of hire, social security number, we keep track, hours worked, that's important for vesting purposes. Usually we design our plans. It takes 1,000 hours in order to earn a year of vesting service. So that's important for us to know. And then we build on this each year and their current annual earnings. Where it gets a little more complicated is really the owner. And it can get complicated depending on the type of organization you are. For instance, if you receive a W-2, that would be a C Corp or an S Corp, we use that. That's what we use for your salary in the testing. Pass-through income of sub-S Corps doesn't count. So that's not counted for earnings in terms of qualified retirement plans. I guess if I stop on this topic, there's oftentimes we receive requests for proposals and the individual says, oh, I take a very low salary. I take maybe 40,000, but my pass-through is 300,000. Well, what we talk to them about is, well, let's talk about rearranging that. Maybe that salary should be $200,000. Now you pay a little more Social Security taxes, but that gives us the ability to do so much more within the retirement plan. So that's kind of, keep your mind open in terms of W-2 versus pass-through income of sub-S corporations. Sometimes the trickiest part is sole proprietors or partnerships in the net earned income. Often we would like to have the CPA involved. We like to have maybe your Schedule C completed prior to pension expense because we have to come up with your income and to determine the contributions to the plan. But you need to know the contribution to determine the income. So anyway, it becomes a little bit more cumbersome, I guess, to come up with income when you have a sole proprietor or a partnership. But that's step one. So now we have information. Next slide is, well, what do you have in the plan? It's best for us to be duplicated on your asset statements. That way we get them electronically. You don't have to keep track of them and so forth. We receive them electronically, we store them. And what we use those for is they're used in the calculation, the funding calculations. So we're going to calculate liabilities by person or theoretical account balances in the cash balance plan, compare it to your assets, and tell you your contribution ranges. Calculate those contribution ranges. It's nice to have those assets because we can see when you made your deposits. We can see how much the investments are growing or not in a particular year. And it just helps us do our work. So each year we reconcile those and summarize the activity. Then we'll move on to what we do for you is we prepare an annual actuarial valuation for the cash balance plan, and it develops a minimum required contribution. Kevin Abrams, our next speaker, is going to talk to you more about these contribution ranges, but there's going to be a minimum. ERISA, it's a traditional pension. You're going to have a minimum required contribution. Sometimes they're large, sometimes they're zero if your plan is very well funded. Then there's a recommended contribution. This one, we usually like to keep those theoretical account balances. That's how a cash balance works. It's a contribution. It looks like a 401k. It's a fixed rate of interest. It grows with a specific rate of interest, and you have an account, a theoretical account. And we give a recommended that keeps you in line with that. We try to avoid surprises. Then lastly, you're going to see a maximum tax deductible contribution. And that is, some years you might have a banner year. You might want to pre-fund as much as possible next year or the following year's contributions. You can do that with cash balance plans. So they do have an element of flexibility as long as you're making the minimum required contribution. Then we go through all that non-discrimination testing David talked about to make sure that everything is working and in balance. And lastly, we produce a participant statement of account balance. So I'll give you a real quick example. Let's say our example is we want to give the owner $100,000 a year that will grow with 5% interest. So at the beginning of the year, his account balance was 100,000. At the end of the year, it's 105. That's 100,000 plus the 5% interest credit. And maybe your staff will receive 5% of pay. I'm making up these numbers, but these are the kinds of things we see when we design these plans. Well, what we do then is that's the account balance, the theoretical account balance. Now we compare it to the assets and decide which one works, how much you should put into the plan with the flexibility I described earlier. On the next slide, you determine the appropriate level of funding. So basically, this is where you consider how well funded you are. So let's say I made that promise of 105,000 and I put in 100,000, but I lost 20%. So I only have 80,000 in the plan. Well, you're going to have to make that up over a period of time, either through investment return or additional funding, so that we end up with the 105,000 at the time it's to be paid out. So all this happens, and you think about where you're at. You think about the available funds you have, the tax implications, talking with your CPA. And then we just need to know the dates and amounts of the calculation of the contributions for calculation purposes. And you should remember that you can make these contributions all the way up until 8.5 months after your plan year ends, and they can be accrued for tax purposes. Now, you will have to go on extension to accrue them, otherwise they're due by your tax date. But even cash basis taxpayers can accrue the pension contributions. So I think that's an important point to know, is you have time to make these contributions. Of course, you can always make them earlier. Annual reporting is the next slide. Basically, under the annual reporting is, well, what do you have to do to report this to the government? Well, we complete for you something called a 5500 filing. It's the tax filing, or the information filing for the retirement plan. If you have a 401k, you're doing one for that, and you have to do one for the cash balance pension plan as well. The cash balance pension plan also has a Schedule SB. That's an actuarial statement. We actually complete it and sign it that talks about the funded status of the plan, the assets, the liabilities, how much you put in during the year. Those types of things we report to the government. It comes with your 5,500. We'll prepare the Pension Benefit Guaranty Corporation filing if your plan's covered by the PBGC. I'm going to talk about that in a minute, but basically you have to pay a premium. This is a government entity. You pay a premium when you have a pension plan, and the purpose of that premium is to guarantee the benefits if you should go out of business without having a fully funded plan. Then what you have to do is you have to sign it and then submit payment to the PBGC, that premium that I just discussed. Lastly, your responsibility is distribute employee statements so they know what they have in the plan and any required notices, and we'll provide those at the end of the year. So what makes a plan subject to PBGC coverage? Well, in general, all plans are subject to the Pension Benefit Guaranty Corporation coverage unless your plan is only for an owner employee. That could be a husband and wife. But if you only cover yourself, you're not subject to PBGC. You don't have to pay the premium, and you just go on and fund the plan as normal. If you're a professional services organization and have less than 25 employees or 25 participants, for example, doctors, lawyers, CPAs, architects, etc., you're exempt from the Pension Benefit Guaranty Corporation coverage. One of the areas that I found is a little confusing is you think of investment consultants and you say, well, they're professionals, but not always. So if we have an investment advisor that wants to put in a cash balance plan, we usually go to the PBGC to determine whether they're covered or not, because it depends on the structure, and I don't know all the details, but all I do know is that it depends depending on how you earn your income and otherwise. So it's always a good idea, if there's any question, to go to the PBGC and get clarification up front. What should you pay attention to on the next slide? I guess I know if you have a plan, you want to pay attention to a few things. First, changes in the employee demographics. I told you earlier how younger employees compared to older owners is the most favorable results. Well, that's true and will continue to be true. But let's say you're a small company and you have a 35-year-old that decides to do something different, and you replace them with a 55-year-old. All of a sudden, all that testing we've done in the past isn't turning out as favorable as it once was. So anytime you have a change, let us know. Now, you let us know at the end of the year with the census, and we're going to observe that, and they're not eligible yet, but we'll want to take possibly some action because that could dramatically change the results for you. So you keep your mind on that. Significant changes in investment performance. Remember, this is a defined benefit pension plan. We have a target that we're funding for. Sometimes it's the maximum target. And big changes in investment performance change your contributions if we're not on track for that target. This doesn't mean a whole lot early on in a plan, but it means an awfully lot as you get closer to retirement. For instance, these last couple of years, who would have expected the performance that you've received? Let's say you had a 20% return on your pension fund. All of a sudden, you probably went from an underfunded plan to an overfunded plan. If you're younger and have years to go, it's not really a problem. We just ease up on the contributions, put in less, and end up at the same target. But if that happens in the last year of your plan, when you're ready to retire, there's some maneuvering that needs to be done. So we look at it, can we amend the plan, improve it, change it to use up this excess? Because if you have too much money in your plan, you have to revert it back to the company, pay taxes on it, and there's excise taxes. at least 20%, but maybe 50% if you don't have some sort of replacement plan or sharing of that excess. So anyway, pay attention to that. Investment performance, especially in the later years of the plan. We can always amend your plan if objectives change. You aren't locked in forever. Now, you shouldn't amend it every year, but you should look at this and say, this is my goal and my objectives today. But if those change in 3 years, we can amend it, cut it back, increase it, whatever's appropriate. So it can be changed from time to time. And I know I say this over and over again, but as you approach retirement, pay close attention to the funded status of the plan. Going way back to the beginning where we talked about your investment advisor, your CPA, and us, this is where more attention should be paid, and we should work together for our clients. Plan termination. So the plan's doing its job. When do you discontinue it? Well, you might do it when the business is sold. You might do it if your business goes down and the plan is too costly. You can always freeze a plan and terminate the plan. You have to promise what was guaranteed under the plan to date, but the future of it isn't promised. So you always have to take care of the past, but don't have to commit to the future. Or most often the plan's just run its course. So that 60-year-old that I talked about earlier in the presentation is now 65 and maybe wants to retire. He's filled up his bucket and he wants to take it and discontinue the program. That happens more frequently than anything else. Well, how do you terminate it? Oh, I mean, you have to amend it to terminate it. That makes sense. It's a board resolution or a decision to do that and amend the plan. You have to tell the people in the plan that have a benefit that you're going to be discontinuing it. They'll receive a package and it'll show them their cash balance account and it'll show them their monthly annuity if they prefer a monthly annuity. Almost always people take the lump sum, roll it over into an IRA, hopefully, and then take the distributions out of the IRA like any other IRA. The plan's covered by the PBGC. There's additional filings. You have to let PBGC know. You have to let them know if it's sufficient. And you also, after it's all paid out, have to confirm with them that you've paid all the benefits due under the plan. Sounds kind of simple, but it takes time. And the reason it takes time, several months actually, probably as many as 8 months to a year for a PBGC covered plan, is because all of these items and notices have various time frames in front. In other words, you have to let people know 60 days in advance that you're terminating the plan. So that adds 2 months. Then you have to give them 30 days to think about their option, lump sum versus monthly annuity. That's 30 days. And you have to do other things in the middle. So that's why it's never as quick as you might like. You know, a lot of times you say, yeah, I want to terminate. Let's pay them out tomorrow. Unfortunately, it takes a little bit more time than that. And that's really, I think, the conclusion to my part of the plan, or the program. Cash balance plans are great. You can put in significant contributions. The testing is complicated, but we do all that for you. And if the plan works for you, that's what we'd like to provide for you. So that's the service Definity provides. Do we have any questions at this time? If not, I see I have just a couple of minutes. I think I'm going to mention something that is unrelated to cash balance plans, but I always found it interesting many years ago and still find it interesting. And it's really related to Social Security benefits. I don't know if you know this or not, but you know how if you make $50,000, you pay a tax rate of 7.65% of the 50,000. Well, 6.2 of that goes for retirement. And if you make 100,000, you pay twice that amount. If you make 150,000, well, that's a little bit over the cap, but it's almost 3 times that amount. Well, the other thing that was indexed when we were talking about the new limits is something called Ben points. And I don't know if you know this or not, but when they go to calculate your Social Security benefit, they have different points. They give more credit to the lower wage earners. They want to have a basic standard of living for everybody. So what they do is if you make under $1,024 per month now this is a 35-year average, you would receive a benefit of 90% of that when you retire. Then that phases down to 32% on the next 6,172 a month, and anything over that is at 15%. So I just find this interesting. Why we can do some of these things in retirement plans to favor highly paid is because Social Security is the opposite. They favor the lower paid. So when you look at it in the aggregate, it's a little more balanced. So that's just for what it's worth. Well, this time then, I think unless there's no questions, I'll turn it over to my friend and colleague, Kevin Abrams. And Kevin's going to talk to you. The final segment of the cash balance discussion would be the funding requirements, funding cash balance pension plans. So thank you.